Welcome to the Deep Dive. Today we're tackling something really critical, a high-stakes situation many investors unfortunately face. We're talking about recovery. Real recovery after, well, serious portfolio losses. Maybe 30%, 50%, maybe even more of your starting capital. This isn't just about tweaking things. We've got a detailed professional playbook here, a mission to restore not just your account, but just as importantly, your confidence.
It is a tough subject, absolutely. But the material we've synthesized for this deep dive, it offers a rigorous path. It comes from what's described as an AI investment expert. And look, they set a very ambitious goal, a 1 to 2 year mission, not just getting your capital back, your initial capital, but actually aiming for a 100% profit beyond that point.
Hold on a second. 100% profit on top of full recovery. That sounds incredibly ambitious, maybe even unrealistic for someone who's just taken a big hit. How's that justified?
That's a fair question. And the source tackles it directly. The core message is failure isn't final if you learn from it. They actually normalize this, pointing out that legends, Buffett, Soros, Dalio, they've all faced huge setbacks, massive capital losses. The ambition comes from the strategy itself. It's built on extreme discipline, high probability selection. It's designed to maximize growth potential while keeping a very tight rein on risk. So today, our job is to break down that strategy step by step into a practical roadmap for you.
Okay, let's get into that roadmap, step one. And it's interesting, the starting point isn't the market at all, is it? It's internal. If you're not picking stocks yet, what's the real foundation for this recovery strategy?
The foundation, and the guide is very firm on this, is psychology. It states quite powerfully that 90% of investor failure stems from unstable psychology. You can have the perfect strategy, but if your mind is still panicking or trying to get even or just acting out of fear, it won't work. This first step requires empathy, yes, but also immediate, unwavering discipline.
90%? That's staggering. It really highlights the biggest risk often comes from within. So what's the very first action, the first concrete thing you need to do?
Acceptance. Simple as that, but hard to do. You have to accept the reality of the loss and, importantly, reframe it. See it objectively, like tuition, a fee paid for a hard but valuable lesson. The guide strongly advises this. Sit down. Write out 3 specific, honest reasons for the losses. Maybe it was, I went all in on one volatile stock, or I didn't use a stop loss, or I traded based on rumors. Get it down on paper, not to beat yourself up, but to learn the lesson properly.
Right, turning it from a personal failure into, well, a data point, a lesson learned. So once you have that clarity, what's next?
Immediately after that, a complete trading halt.
Yeah.
Absolute pause for 5 to 7 days, minimum.
No trading at all.
None. It's non-negotiable in this strategy. The main reason, to kill revenge trading, that desperate emotional scramble to win back losses immediately. The source warns, and this is stark, that 8 out of 10 revenge trades, they result in further losses, deeper losses. This pause, it's about restoring calm, balance, getting back to rational thought.
8 out of 10 fail. Wow. Okay, that statistic alone is compelling.
So the pause creates space. How do you then start building better habits, new, more resilient ones?
That comes in weeks 2 through 4. The focus shifts entirely to building discipline. Real, practical discipline, the guide says. Write down 3 golden resolutions. These are your core personal trading principles, things you will stick to. And they must be visible. You review them daily.
Like what? Can you give some examples?
Sure. Examples given are things like, I will never go all in on a single position again. Or I will always sell a portion of my holding when I hit 20-30% profit. Maybe the toughest one. I will stick to my strategy, period. No emotional overrides. These resolutions become your new guardrails. That sounds like a serious mental commitment. Okay, let's say you've done that hard work. You've reset psychologically, paid your tuition. Where do you go now? You need a system, right? A professional playbook.
Exactly. Willpower isn't enough. So we move from the internal defense to the external action. Step 2, the 6 selection criteria for stocks. And what's interesting here is the guide avoids overly complex models. It boils down quality into 6 basic measurable checks. And they're very clear. If a company meets all 6 criteria, the probability of a successful investment goes up dramatically, like 70 to 80% success probability.
70 to 80%. Okay, that's a significant edge. Let's break down those 6 rules. How does this strategy ensure you're picking fundamentally sound companies with lower risk?
It starts with financial health and valuation. You need that margin of safety, especially now. Criteria 1, PE ratio, price to earnings, must be below 20.
Below 20, pretty conservative.
Yeah, very. In a recovery mission, the guide rejects those high-flying speculative valuations. You need proven value. Criteria 2, ROE, return on equity, must be above 15%. This shows management is actually effective. They're using shareholder capital well to generate real profit.
Okay, so reasonable valuation, proven management, effectiveness. What about debt? That's always a major risk.
Absolutely. Criteria 3 addresses that directly. Debt to equity ratio. This measures financial risk, leverage. It must be below 1.0. Basically, the company's total debt should be less than its total equity. You're actively avoiding businesses that are dangerously leveraged, the kind that can implode in a downturn.
PE, ROE, debt equity. Got it. Solid foundation checks. What's next? We need growth, right? For that recovery and profit.
Precisely. Criteria 4 focuses squarely on growth, revenue growth. It needs to average over 10% annually for the past 3 to 5 years. This is vital. You need companies moving forward with real momentum, not just sitting still. Then, criteria 5 tackles quality. Cash flow quality. Here's the check. Cash flow from operations must be greater than net income.
Ah, that's a smart one. Making sure the reported profit isn't just accounting games, but actual cash coming in the door.
Exactly. It filters out companies with potentially misleading earnings figures, ensures the profit is real.
Okay, that covers 5 fundamental checks. What's the 6th criterion? You mentioned timing. How technical does it get?
The 6th is about confirming the market agrees with the fundamentals. Criteria 6. The stock price must be in a clear, confirmed uptrend. The guide suggests practical checks, like ensuring the price is trading above key moving averages. The 50-day and the 200-day are mentioned specifically. This often indicates institutional buying, positive momentum, and supporting indicators, like RSI and MACD, should also be positive. You're looking for market validation of your fundamental analysis.
Right, so even if the numbers look good, you wait for the chart, for the market itself, to confirm that upward momentum. That helps avoid catching falling knives, I suppose.
That's the idea. It balances the fundamentals with market timing. And to make it concrete, the guide even suggests potential sectors for 2025 based on this strategy. Healthcare, tech AI.
Tech AI makes sense.
Yeah, they cite Palantir's run, over 100% profit. Also, energy and materials, mentioning Western Digital, up 78%, Newmont over 100%. Picking strong stocks and strong sectors obviously boosts your odds of hitting those profit targets.
Okay, so we have the mindset fixed, the strict stock selection rules down. Now, step 3, this is where you said it gets really interesting. How does this AI investment expert actually use AI in this recovery strategy?
Right. AI's role here is very specific. It's about speed and efficiency in research, not decision-making, but research. Think about analyzing a 10K report, comparing competitors, calculating those ratios that used to take, 5-6 hours maybe?
For one company.
Easily.
If you're doing it thoroughly.
With the right AI tools, the guide suggests you can get that initial screening analysis done in about 10 minutes. It frees up enormous amounts of time for the actual thinking and decision-making.
10 minutes versus hours. That's a game changer. Which specific tools are recommended for running these 6 criteria checks?
2 main ones are highlighted, each with a slightly different strength. First is Perplexity AI. They call it the answer engine. Its power is pulling real-time information with sources. So you could upload a company's 10K PDF, the source for most of our first 5 criteria, and ask it specific questions. Like, summarize the key risk factors, or what was the annual revenue growth for the past 5 years? Or even, does cash flow from operations exceed net income? And you get cited answers in like a minute.
Okay, so Perplexity is for fast data extraction and summary, pulling the numbers and facts needed for the checklist.
Precisely. Then the second tool mentioned is ChatGPT. It's seen as better for more complex structured analysis or calculations if you give it clean data. For example, if you provide the necessary financial figures, you could potentially use it to help run a discounted cash flow, a DCF valuation, to double check if that PE under 20 makes sense from a valuation perspective. It supports your thinking.
So AI handles the heavy lifting on the quantitative side, speeding up the screening, but I feel a big but coming. It can't replace your own judgment, can it?
Absolutely not. And the guide is emphatic about this. AI is an assistant, a very fast, capable assistant, but it's not the boss. It provides data rapidly, but it can't replicate your critical thinking, your assessment of qualitative factors, management integrity, market sentiment. That's still on you, the investor.
Makes sense. How much time does the streamlined process take daily?
The suggested workflow is actually quite lean. Maybe 20 minutes a day for checking news, running quick AI checks on potential ideas, plus a focused, maybe 30-minute deep dive on the weekends to really solidify plans.
Okay, 20 minutes daily, 30 on weekends. Manageable. But, selecting good stocks, even with AI's help, is only part of the equation. Often where people really fail is money management. What's step 4? The piece that dictates long-term success in this strategy.
You've hit it exactly. Step 4 is all about money management and, crucially, absolute risk control. This is non-negotiable for capital recovery and long-term growth. Let's start with portfolio allocation. Defense first. The guide uses a $20,000 example portfolio. Diversification is presented as your primary shield against unavoidable market risk.
How should that hypothetical $20,000 be allocated for someone in recovery mode?
The recommended split is quite specific. 40% goes into value stocks, stable companies, low PE ratios acting as anchors. Then 30% into growth stocks. These are the engine for hitting that ambitious profit target, but you acknowledge they carry higher risk. 20% is allocated to dividend stocks. Companies known for stability, often more resilient in recessions, providing those steady payouts. And finally, crucially, 10% is held in cash as a reserve.
That 10% cash, why is that so important?
It's your strategic firepower. It's kept aside specifically so you can seize opportunities when the market inevitably corrects or dips. You're ready to buy quality on sale.
Smart. Okay, that's the allocation structure. But the real core of risk control comes down to those 2 golden rules you mentioned earlier, the absolute must-dos.
Yes. These are the pillars holding up the entire strategy. Rule number 1, stop loss. Mandatory. Absolutely mandatory. It must be set the moment you buy, typically, and then it's in this 10% below your purchase price. So if you buy a stock at $100, you have an automatic sell order trigger at, say, $92 or $90. No exceptions.
And the guide's view on ignoring this?
It calls ignoring the stop loss financial suicide. Plain and simple. The surest path to losing all your remaining capital. And the logic behind this strict, small loss cut. It's the simple math of recovery.
Explain that math again. It's so fundamental.
It's stark. If you let a loss run to 50%, your remaining capital needs to make a 100% return just to get you back to where you started. 100%. But if you cut your loss at just 8%, you only need an 8.7% gain to break even. It's vastly easier to recover from small losses. So preserving capital with strict risk control, taking that small hit early, is always superior to hoping a big loser turns around.
That really drives home why discipline on the stop loss is paramount.
Okay.
What's the second golden rule? It's about taking profit, right?
Yes. Rule number 2, always take partial profits. Have a plan for selling in stages as the stock goes up. The specific tactic recommended is, when a stock hits plus 20% profit, sell half, 50% of your position.
Sell half at just 20% gain? Why so early?
Because that action locks in some profit and, more importantly, it recovers a significant chunk of your initial investment. It dramatically reduces your risk on the remaining shares. Then, if the stock keeps running and hits plus 50% profit, sell another half of what's left, so 25% of the original position. You let the final 25% run, aiming for further growth, but by this point, your initial capital is largely protected or even fully recovered.
Yeah.
The psychological pressure is massively reduced.
Right. So by the time you're up 50%, the trade is essentially paid for. You've banked profit, reduced risk. That makes holding the rest for more growth much easier emotionally.
Precisely. It shifts the dynamic. It prioritizes capital survival and builds a winning habit. Taking profits systematically, not greedily.
This has been incredibly thorough, a really disciplined roadmap. Let's try to pull it all together now. Can you summarize the core steps and talk about the specific 30-day plan to implement this?
Absolutely. The whole recovery strategy flows systematically. From fixing the inside first to taking disciplined action outside, the 5 core steps boiled down to 1. Psychological reset, acceptance, the pause, building those golden resolutions, discipline first. 2. Mastering those 6 selection criteria, the fundamental and technical checks for quality and timing. 3. Leveraging AI tools like Perplexity and ChatGPT, but only for speed and analysis assistance, not for decision-making. 4. Implementing ironclad risk management. That means portfolio allocation, the mandatory stop loss, and the partial profit-taking strategy.
And the 5th step ties it all together into action, right? The 30-day plan. How does someone actually start building these habits?
Step 5 is that execution timeline. The first 4 weeks are intensive habit formation. Week 1, all about psychology. Write the reasons, take the pause, set resolutions, maybe start testing the free AI tools. Weeks 2 and 3, focus on mastering the key metrics like PE and ROE. Practice applying the 6 criteria, refine your selection process on paper or in a simulator. Then, by week 4, you execute your first 3 to 5 trades following the plan exactly. journaling every single decision, why you bought, where the stop loss is, the profit targets. Professionalize your routine.
And if an investor sticks to this level of discipline, really commits over the long haul, what are those growth projections again? They were ambitious.
They are ambitious, but the strategy is designed for it if discipline holds. The guide projects the potential for significant compounding returns. Year 1, the target is plus 40% profit. Year 2, aiming for plus 60%. And after that, as skills compound along with capital, the target moves towards plus 100% or potentially more per year. But it all hinges on the final non-negotiable rules. Never, ever ignore your stop loss. Never go all in. Always journal your trades. Remember, AI is just an assistant. And crucially, discipline trumps talent every single time in this game.
Okay, a final thought then. Considering just how damaging severe losses can be, that erosion of self-trust, that fear, what do you think is the single most important first habit someone needs to build to genuinely start restoring that confidence in their own decisions?
That's a deep question, hitting the core of the psychological recovery. For me, based on this material, it has to be the mechanical act of setting and honoring the stop loss. Not just setting it, but letting it execute. Every single time, without interference, even when it stings. Successfully doing that repeatedly is concrete proof to yourself that you can control your actions, follow your rules, and manage risk effectively. That consistent, disciplined behavior, however small the trades initially, is probably the fastest way to rebuild that fractured self-trust and lay the foundation for future growth. It proves you're back in control.